a new metric to evaluate crypto ecosystem fundamentals. The years to profitability ratio is a good way to evaluate a level 1 blockchain. When evaluating layer 1 loan blockchains, many fundamental investors focus on metrics such as price to earnings or price to sales ratios. While these metrics are important, they ignore the programmable aspect of a blockchain's token supply. Because a blockchain's emission schedule, i.e., when new tokens will enter circulation due to staking rewards and token unlocks, is known, its cost structure into the future is essentially known as well. The years to profitability (YTP) ratio is a useful new metric for analyzing and loans profitability as it incorporates the blockchain's forward supply curve. It applies the traditional finance TradFi concepts of breakeven analysis and payback periods to crypto. The analysis views and loan blockchain through the lens of a business that sells secured block space. Revenues are the fees that users pay to record transactions on the chain, and expenses are the costs needed to secure the network. YTP calculates a blockchain's profitability timeline by factoring in the protocol's current revenue and cost structure, a projected growth rate CAGR, and future supply dynamics. You're reading Crypto Long and Short, our weekly newsletter featuring insights, news, and analysis for the professional investor. Sign up here to get it in your inbox every Wednesday. We find YTP compelling because it provides a comprehensive framework for evaluating an individual blockchain or comparing multiple blockchains. We start our calculation with Token Terminal's definition of loan profitability. It is important to note that all revenues and costs are denominated in the loan's native token. And while unlocks and staking rewards both increase the number of tokens in circulation, the difference between transaction fees and the portion of those fees paid to proof-of-stake validators is what is used to burn or reduce the number of tokens in circulation. In this sense, YTP measures the point at which a loan's circulating supply stabilizes at 0% inflation. Some broad assumptions we make are: the percentage of the transaction fee burned remains constant. The foundation takes 10 years to sell all its tokens. For revenues, we use the loan's revenue for the last quarter annualized. In comparing YTP across blockchains, it's helpful to group the loans by whether they have an inflationary tokenomic model or a max supply model, because with the latter, a loan might break even simply because the chain's fixed supply was reached as modeled for SUI or ADA. Here's an analysis for multiple blockchains with Ethereum and Binance Smart Chain excluded because they are already profitable. Then, by using the same set of growth rate assumptions for each chain, we calculated future CAGR of 30%, 40%, and 50%. We can make comparisons across chains and explore more deeply what drives YTP. For example, while APT has a high YTP, this is partially because the chain is relatively new and therefore its revenues are smaller than those of other more established chains. SOL has modest inflationary schedules compared to blockchains like Near or Ike. In all examples, a blockchain's ability to burn tokens and provide some kind of offset to new emissions is helpful for managing YTP. In conclusion, YTP serves as a crucial metric in evaluating the profitability and sustainability of loan blockchains. By carefully designing tokenomics inflationary or max supply, balancing supply dynamics, and incorporating burn mechanics, loan blockchains can aim to reduce YTP and build a more sustainable blockchain economy.